I'm currently helping a loved one with their retirement planning, so I'm on a data-driven quest to find the best ETFs for retirement, for that reliable and steady dividend income. If you think it's SCHC, you are sadly mistaken. And I promise by the end of this video, we're all going to walk away knowing objectively what the best options are going to be out here. And the best part is, I am not invested into any of these ETFs that we're going to talk about here today. So Scout's honor, no bias, and we can take personal feelings out of it as we evaluate each one by one, and then grade and ranking them against one another. And by the way, this is the retirement edition of finding the best dividend ETFs. If you are young, or if you are in your working years, or you're looking for the best dividend growth ETFs, well, I already made a video on that, so go and watch that one before you watch this one. Because this video is catered for those that are looking to retire in the next handful of years or so. With that said, what are the criteria and metrics and qualities that we're going to be evaluating these ETFs on? Number one is going to be safety. I know, that's very subjective, so I tried my best to quantify what makes an investment option relatively safe. Because I imagine if you're 65, or if you hit the lottery and you won millions of dollars at age 22 and you're trying to retire, and you have your life savings, the last thing that you want to do is put it into something that is speculative, junk, or crap, and for you to lose it all, correct? So I think safety is going to be a top priority. And to assess safety, we're going to be looking at the volatility and sustainability of the dividends, because between you and me, it's not enough just to have a high dividend yield, like a yield max ETF that pays out like 40 or 50%, which is pretty crazy, I'm not gonna lie. We need to know that it's going to be safe. Is it going to be reliable? Is it going to be consistent? Are they predictable and normal? Or are they going up and down, up and down? Sometimes they're cutting it by 40% and sometimes they're increasing it by 10%. Very inconsistent. I don't like that. If it varies by the month or the quarter because of covered calls, that's going to impact the safety factor. And then also we're going to be looking at the quality of the portfolio itself, like the strategy. What are the holdings? What are the top 10 companies that comprise the ETF itself? Are they in the consumer staple space, the utilities and boring big companies? Because those tend to be more stable during downturns. Or are they invested more heavily towards tech or cyclical sectors and industries? That is inherently a little bit more volatile and, I guess, quote unquote, risky. And we're also going to be considering the capital preservation of the ETF itself. And we're going to be looking at their worst years, and we're even going to consider their maximum drawdown years to assess how much into the red are they going to go in any given year. Because in retirement, I think it's going to be really important to preserve the capital that we have, right? It's not enough just to have $1 million dividend portfolio. If the next year it's going to drop down in valuation to 900 grand, and then the following year it drops down to 700 grand, but you're still getting a 40 or 50% dividend yield, it just doesn't make sense to me. And that's why this might be controversial, but I decided to not include any of the yield max ETFs. And we'll talk more about my reasoning and opinions towards the yield max ETFs at the end of the video, if that's okay with you. So to sum up the safety criteria, it's important for us to preserve the capital that we have on hand and to maintain a good dividend than it is for us in retirement years to be chasing the CAGR or the growth. Because ultimately, what's more important is, can this ETF weather the storm during downturn events or macro environment sell-offs, or when the stock market is just really scared and fearful? Will this ETF be okay? Can they navigate through the tough times without going too far into the red? The second criteria and metric that we're going to be considering is their history. It kind of coincides with the first one, but I guess it's an extension of safety. So the history, I broke it down into 3 categories. How they fared in past storms. Number 2, their dividend history. And number 3, their lifespan. If an ETF has a more comprehensive timeline of being on the stock market for 20, 30 years, because call me old school, but I think it's nice and it's good for us to be able to look back at their past and their history to see what they were doing during, like 2009 or 2012. But if an ETF has only been publicly traded for like 3 or 4 years, we don't know exactly how they're going to do during the Great Recession or during another pandemic-like event. So we are going to dock a few points for that. And the last metric we are going to consider is their dividend health and ultimately the yield. We want to know, is it going to be consistent and stable? Because if you are retired, you want that cash flow to be predictable, right? If you have your finances and budget planned out for you to have a 4% dividend yield year over year, you want to see 4%. You don't want to see it fluctuating into the red or into the green and have all of your financials messed up and spontaneous and volatile. And believe it or not, it's probably not the best for us to be chasing, an ETF that has like a 25% dividend yield if we know that it's really volatile and risky. So nothing too crazy, but bigger the yield is in terms of a range, anywhere from 3.5 to 7%. I think that's the sweet spot. I think that's what I mean when I say a juicy and a good dividend yield in retirement years. Because ultimately, the investment options that boast about being able to give a 40 or even a 50% dividend yield, I think they are yield traps. I promise we'll talk more about why I just said that later in the video, but now let's go ahead and talk about Dividend ETF number 1, which is the ProShares Noble S&P 500 Dividend Aristocrats ETF. Essentially, Noble consists of the S&P 500 companies that have been growing their dividends for at least 25 years, which on paper sounds like a fundamentally sound strategy for an ETF. And as we take a look at their top 10 holdings, this is where I kind of deviate away from, okay, in theory it sounds good, but in actuality feels kind of iffy. When we take a look at their top 10 holdings, I get that all of them are going to be S&P 500 companies, but the only ones that I feel comfortable with would include Walmart, Church & Dwight, and maybe Clorox. The other ones, I'm just like, I don't know. And something that I do want to call out is their expense ratio is 0.35%. And these expense fees, it gets baked into the return potential. So let's go ahead and assume that this ETF, their capital appreciation, which if you're in your retirement, you shouldn't really care, but it's good to know the logic and what happens, the systematic process to how it all unfolds. Let's say in 365 days, the ETF grows by 10%. Instead of you seeing 10% reflected in your brokerage account, it's going to be 10% minus 0.35%. They take away from your return potential. However, what I do want to say is good fund managers, I think they're worth their weight in a 1% or 0.5% fee. If we're going to be honest, it's not that bad and that big of a deal, especially if they're giving you a pretty sizable chunk of return. But if the fees start getting up there, like 5%, 7%, or even 10%, that's when you got to pump the brakes, park the car and turn around and take a look at them like, do you actually have my best interests in heart, or are you taking advantage of me? Something to think about. And when we take a look at Noble's history, they've been publicly traded since about 2013. A pretty long and vast history on the stock market for us to kind of gauge how they perform during the good times and during the bad times. Now, when we take a look at the pandemic era, February of 2020, they went on a massive sell-off. I think they were down at 31% at one point. However, by the end of the year, they pretty much recovered and they actually finished the year in the green. So when I see that kind of a dip, I'm not too concerned because when you think about your portfolio, by the end of the year, you would still be in the green. However, they weren't always in the green for every fiscal year. Their worst performing year was in 2022 when their ETF was down by 6.5%. And also in 2018, as you can see right here, this peak and valley, they were also down by about 3% for the year. As a matter of fact, most of the ETFs that we're going to be talking about here today, they had their worst year in 2022. There are some outlier examples, but 2022 was a rough year for equities and ETFs in the stock market, at least in the last 10 years, that is, because not all of them have a timeline that goes beyond 10 years like Noble does, which I think this is a pretty good thing. And when we jump over to take a look at their dividend profile, their dividend yield right now is not the juiciest, because I don't know about you, but a 2% dividend yield in my retirement income generating dividend portfolio is not going to cut it. However, as we take a look at the health and the history of it, I think this is where they get some brownie points. Because as we take a look at this, what you want to see is their dividend payout growing in the right trend and direction and going on a gradual incline. You don't want to see very extreme peaks and then for it to just drop off the cliff like you're driving drunk. You don't want to see that. So I think for the most part, their dividend health looks pretty darn good. Just not a huge fan of the dividend yield itself being so low. I think the sweet spot, as we referred to earlier, is 3.5% at a minimum. For a dividend portfolio in your retirement, come on, 3.5%, that's not asking for too much. And a 7% would be like the upper range of what I would feel comfortable with for it to be sustainable and growing. So when it comes to Noble, I think what is fair for them in the safety category is a grade letter of a B+. I think because their worst year, they only went down by -6%, that's not too bad at all. Meaning if you have like $100 in your retirement portfolio, by the end of the year, in the worst performing year, and the valuation would be $93.49. However, the next year it would rebound and you would be back up into the green. So I thought the safety, their history, their dividend, I think it looks pretty good. And in terms of their dividend health, I thought that was spectacular as well. The reason why I have it coded as a red is because for us, for retirement, at 2% is just unacceptable. But all that to say, at least the dividend is healthy and it's sustainable. So when it comes to Noble, in terms of a retirement dividend ETF, I think I would categorize him as a solid C+ type of investment option. The reason being is I really think their dividend yield is what is holding them back. But overall, I think Noble is a very good ETF, especially for retirement. So I guess a B- or a C+. I think right now, let's just go ahead and put them into the C category, which for me does not mean that it is bad or inherently evil or disgusting or smelly. There's nothing too crazy about them or anything delicious either. It's just vanilla. It's like going to a pizza shop and ordering a slice of cheese pizza, knowing there's so many toppings available. We're just going to go ahead, C. Let's move on to the next one. The next ETF is going to be Vanguard's High Dividend Yield ETF. Ticker symbol VYM. The expense ratio is 0.06%, which I think is pretty good. If you're going to have a fee baked into my returns, at least have it as low as Vanguard's. And their strategy is kind of interesting. They try to pick large cap, so big companies in the stock market that have above average dividend yields. And I'm going to be honest with you, looking through their documents, their screening criteria and process to join their portfolio is not as strict as I would like it to be, which means the possibility of having some value traps sprinkled into their portfolio, the likelihood is going to be pretty high. So above average paying dividend companies that are big in the stock market, as we take a look at their biggest top 10 holdings, at least they're all blue chip companies with solid financials and fundamentals. Every single one of these companies I think are good. Do I like them? That's a different story. But on paper, I think they're good. If you want to hear my personal take and opinion, I really don't like Wells Fargo for their predatory practices against the consumers. I don't like Bank of America. I don't like AbbVie. But the rest of these, I think they're okay. And as we take a look at their history on the stock market, they've been publicly traded since about 2006. So their timeline is even better than the one before. And we can see how they performed over the years. And I'm not saying that past performance is indicative of future gains, but it is good for us to see how they performed according to their fund managers when the times were good or when the times were bad as well. And in terms of safety and volatility, in their worst year, which was 2008 during the great financial crisis and recession, they went down by -30% for that fiscal year. However, they did rebound and now they're back into the green. But if you were to have bought into VYM back in February of 2008 at $48 a share, it would have taken you at least, let's see, when to break even. When it starts, oh, right there. How about right here? It would have taken you at least 4 years to break even. So that is something to take into consideration and in mind. However, in the past 10 years or so, then we're talking about in 2022 when they went down by -5.9%. So in the recent years, their volatility isn't so bad, but if we're going to slap them on the butt with a bat for their performance during the Great Recession, I think that's kind of harsh because not all of these ETFs were publicly traded during the Great Recession. But overall, when I think about their safety and them shielding you from the storm, not too bad. As a matter of fact, I would even label decent. And as we take a look at their dividend profile and the health and the history, I think it looks pretty darn good. It's exactly what you want to see, a trend that is going in the right direction and is ultimately growing year over year. So the dividend history itself for VYM, I really like, but what I don't particularly like is their dividend yield being 2.6%. Of course, it's better than Noble, but just by a hair. We're talking about 0.6%. So to keep things as objective as possible, I'm only looking at the past 10 years when I think of a grade letter for their worst year performance. So when it comes to VYM, I thought what is fair is a B+, because in 2022, they went down by 5.9% when there were other companies that were in the red by 30, 40, 50%. And initially, when it comes to their history, I had it labeled as a C+, but after reflecting and taking other factors into consideration, I think this is a very solid B tier. Not a B-, not a B+, but I think they're above average. They have an adequate amount of time on the stock market, so we kind of know and understand how they do, but also the reputation of their future quote-unquote performance. And something that I do want to call out, referring to my notes, they were in the red by 5.9% back in 2018. And in 2022, they were actually pretty much flat. I just want to call it out there. It's not that big of a deal, but you should know. So when it comes to VYM, am I going to be outrageous or ridiculous for placing them also into the C+ category? Well, I think if I were to pick one, if someone had like a hammer to my nut and they were like, pick one, or we're going to smash your testicle, why did I say a singular? I have plural, I have testicles, but maybe just the left one. Then I would honestly go with VYM, because it has a higher dividend yield, a better history, and the lower volatility during their worst year. So I would categorize VYM as a B- instead of a C+. But I don't think we can put them into the B tier because their dividend yield is just too small, short, hairy, and ugly to be retirement portfolio worthy. Does that make sense? So even though I'm going to place them into the C tier, they're technically a B- C+, just a hair above Noble, but not that much better. We're not talking about like Team USA playing against Brazil in soccer. Not that much of a difference. But rather something like Team Germany playing Team England, or France versus Spain. Something that's more neck and neck, but one of those teams is just a little bit better than the other. And the next retirement ETF that we're going to talk about is Vanguard's Total Bond Market, ticker symbol BND. The expense ratio is so small, 0.03%, which for me, I think that's pretty good. And as we take a look at their strategy, it's basically a portfolio consisting of all of the bonds and treasuries that are available in the US. And when I say the word all, I'm talking about the good and the bad quality bonds. So according to their strategy and summary, they're saying if you invest into us, the capital appreciation to whatever it is you buy into the price for today, it's going to be non-existent. It's going to stay relatively flat. However, we should be paying you a bond yield, or I guess dividend yield, that is equivalent to the inflation and interest rate. That's what BND says. But when I investigated them, I found out in 2021 and in 2022, you would have been in the red overall. And if you're paying attention, then you would also understand that the dividend yield is going to go up and down depending on what bonds are trading for, meaning it's going to be an inconsistent yield. And when we take a look at BND's portfolio holdings, it's going to look very different to the other ETFs. Because you have stuff like mortgage bonds, the U.S. Treasury note bonds, and as you can see, they also hold some cash valued at $2.7 billion, but mostly it's bonds and Treasury notes, 9,875 different varieties. Now, according to BND, they're saying this is a really safe place for most investors to park their cash, and they even label themselves as being very safe. And I guess what they're saying kind of makes sense, because if you bought into them when they started to be publicly traded back in 2007 at $74 a share, then right now at $73, your capital appreciation would have been relatively flat. And I think right now it says negative 1.9% of all time. But I don't really see eye to eye with that. Because if you were to, with that same thought process and logic, saying, okay, if I put a lot of my retirement money into BND as a place for me to park my cash, let's go ahead and say somewhere right here, during the pandemic at about $88 a share, would your capital actually be relatively flat and steady? No, you would be in the red by about 18%. So for me, I think it really depends on when you buy into BND. When you buy into them at a valuation like right now, it's $73, I guess then it aligns with their strategy and their promise of like, hey, this is safe. Your capital appreciation is going to be steady and flat. But on the flip side of that, if you buy into them when they're at a very historically high valuation, like 89 or $88, not a good deal for you. As a matter of fact, during their worst year in 2022, as you can see on your screen right there, they were down by negative 13%. Yes, this is an ETF that consists of bonds and treasury notes. A lot of people assume that it's safe and your cash should be preserved, but that's just not the case of what we're seeing through the data. But as we jump over to take a look at their dividend profile, a 3.6% dividend yield, finally, we're talking about a very decent yield, especially for a retirement portfolio. Could be worse, as we saw with Noble at 2%. When we take a look at the history, this is what I want to call out. In the grand scheme of things, you would think, okay, this looks phenomenal. However, when you look at it in a very nuanced level, back in 2015, sure, you got paid 16 cents every month, and now it's at 23 cents, and you think you would be a happy camper. However, look at what happened in 2021 and in 2022 when the interest rates were basically non-existent, right? It was like, what, 0.25%? Then your dividend yield and your payout went down as well. So this ETF, as we alluded to earlier, it really depends on what the interest rates are. The higher it is, the more your payout. The lower it is, the smaller your dividend will be. So for me, when I think about BND, it's one of those things where I really hate to say it, but you really do gotta time and buy it at the right price. You can't just willy-nilly jump into it because let's say back in 2012, you bought into it for $84 a share. Would you be flat? Would you be okay? No, you would also be in the red by 13%. Or any one of these times where it's above $80, you would not be a happy camper. You would be in the red. Yes, you're getting a dividend yield, but that capital preservation also matters. You don't want to see your portfolio be declining year over year. That's why when it came to grading BND, for their safety, I put it as a C- because it really depends on when you buy into them. Did you buy into it at a good price at under $70? Or did you buy into it at over $80? And I also quantify them as a C- because it seems as if whenever there's a setback in the stock market or the interest rates fluctuate, they also suffer. They're not a very safe mode of investment as they like to claim or as others would like to suggest. This is an ETF where in the grand scheme of things, yes, the share price is relatively flat at about $74 a share, but it really, in between that, right, their huge timeline of 2007 to 2025, so many ups and downs and peaks and valleys. For a freaking bond ETF, wouldn't you expect it to be relatively flat, maybe growing in the right direction at a really small incline, but rather it goes up and down, peaks and valleys everywhere. So their ETF history, I labeled it as a D+. Because it was one of the worst performing ETFs during their worst years on this list. And we're not even talking about just 1 year. It's almost every other year they go deeper into the red in comparison to their peers. For instance, when you just take a look at their past 5 years, this is horrific. This is scary for a bond ETF. And because their dividend payouts are not consistent and they fluctuate depending on the interest rates or what their bonds are currently trading for, I can't justify giving them anything higher than a C+. The reason why they got above average is because their dividend yield is at least 3.5%. But other than that, I'm not a fan of BND. So, all that to say, when it comes to BND for a retirement portfolio, if you buy it at like $68, happy camper. Really good deal, sound strategy. But if you are to put like 80% of your net worth into BND when it trades for like 81, 82, or even $84 a share, dude, that would be an F tier. However, on the basis of them currently being $74 and buying into it right now is $74, knowing that they're relatively flat since 2007, I think this is a very solid D+ type of ETF. because the yield is inconsistent. Their history shows us they're pretty volatile in terms of their share price. Yes, I'm going to say it again. There's this wise ass out there who's already typing, yeah, but in the grand scheme of things, $74 all the way 20 years ago. Like, shut up. I get that. But in between the start and finish for their history, there's so many peaks and valleys. Because I guarantee you, the guy who bought into BND at $80 a share, he's pissed off. If you bought into it at $68, happy. $80, not happy. So I'm taking all of that into consideration to say that's why I think it's pretty volatile. You would assume that bonds are relatively safer in comparison to equities, but when you think about high quality equities, we're going to talk about an ETF that has only high quality dividend compounders, and you'll see the difference in their volatility, especially during the worst years. Then they're not as volatile as a bond ETF. So for me, this was a very surprise finding, and that's why I personally do not choose to invest into any bonds. If I want to preserve my cash and for it to keep up with the rate of inflation, to get at least a 4% return on investment, I would rather just put it into a money market fund or a high yield savings account. Bonds, it's just not for me. I don't see eye to eye with the thesis and the strategy behind it. So a D+. All right, friends and family, the next dividend ETF is going to be the iShares iBoxx investment grade corporate bonds. So unlike BND, this one only focuses and invests into high quality corporate bonds. The good ones, not the entire bond market, but only a subsection of it that meet investment grade qualities. Which also means their dividend yield is interest rate sensitive. And it is worth noting their expense ratio is 0.14%, as you can see right there. So it is slightly higher than BND, but nothing too crazy. And as we take a look at their portfolio holdings, the top 10, I'm seeing a lot of the banks and financials, but I'm also seeing an ancient tech company right there, an Oracle, and there's a health insurance player, and then two communications companies. And please do keep in mind, we're not talking about their stocks. Instead, we're talking about their corporate bonds. And when we take a look at their history on the stock market, it is pretty vast. They've been publicly traded since 2002. And you can see when they debuted, they were about $102 a share, and now it's currently $109 a share. So their strategy of this is a place where you can park your cash for it to be relatively flat, and you can just pocket the dividend yield from our bond payouts. It sounds true in the grand scheme of things from start to finish, except just like BND, when we read between the lines, we can see if you bought into LQD in 2020 at about $135 per share, would you be flat? Would your capital allocation in your portfolio, would it be flat? No, you would be down by negative 19% in the red. So just like BND, when it comes to these bond ETFs, and that's why I really wanted to include this and incorporate it into the retirement ETF ranking and grading system, because we need to walk away from this notion that all bond ETFs are relatively safe in comparison to equity ETFs. It's just not the case. It depends on when you buy into them. You have to buy it at a good price, which is such a shame because when we think about bonds, we associate it as being a really safe vehicle. But as you can see, that's just not the case. And obviously, during the Great Recession, let's look at what happened. If you bought into it right before 2007 at $104 a share, if you survived and held on to it past the Great Recession and during the pandemic, at one point you would have been up by, 30%. If you held on to it, now you would be, relatively flat at about a 4% gain in all those years. So it makes sense. However, it really depends. Like, I think LQD, if you can buy it under $100, good deal. A good place to park your cash because it's going to relatively be around that number throughout the ages at around $102, $104, $109 a share. Unfortunately, if you're trying to park your cash and we go back in time and let's assume it's 2020 and everyone on the internet, all of these financial gurus are like, hey, bonds, they're pretty safe. That's where you should park your cash. And you were to buy into LQD at $137 a share, you wouldn't be happy. So when it comes to their history, I think I like that it has so much depth and a timeline that we can observe what happens to the bond market, quote unquote, during economic downturns. But what I don't like is how volatile they are. When they are up, they're really up. But when they're down, they're really down. Even in the past 5 years, as you can see, by these peaks and valleys, when they're low, they're really low. I just not a fan of this. All that to say, in the past 10 years, you would have been in the red in the years 2018, 2021, and in 2022. Speaking of which, their worst year, they were down by negative 17.9% for the year, for 365 days. Not cool. As we jump over to take a look at their dividend profile, finally, we're seeing the first ETF that has a respectable, with a capital R, dividend yield at 4.3%. The payout schedule, I like. Every month. And as we scroll down to take a look at their dividend history and the growth, this is very inconsistent because it really depends on the interest rate. As you can see, when the interest rates were non-existent, your payout would have been crushed. However, now that inflation is sky high, now your dividend looks good. So their dividend consistency and reliability, if you're trying to calculate and forecast a budget based on a bond ETF, it really depends on what year. It's not going to be like an equity that seems to be more stable. All that to say, when it comes to their safety criteria, I gave them a D+. And by utilizing BND as a cross-reference and a benchmark, because they're also a bond ETF, in their worst year, which also happened to me in 2022, well, they went down by negative 13%. But for LQD, they went down further into the red at almost negative 18%. And that's why I put them down as a D+. For a bond ETF, they're supposed to minimize and reduce the likelihood of volatility, but that's just not the case with what the data says. For their history, I put down a D. And for their dividend health, initially I had it as a C-, but the yield is slightly better than BND. And the situation and scenario of their dividend yield being contingent upon the interest rate, I think they're also going to have to be a C+. I think if I had to pick between the two of these, BND versus LQD, LQD at under $100 a share and BND at under $70 a share, with those parameters in place, I think I would rather go with LQD. But the bigger question is, would I want to buy into LQD or BND? The answer to that, full transparency, no, I wouldn't want to. No, there's better options. There's other opportunities and higher dividend yield paying, safer, less volatility ETFs that we're going to talk about here in a little bit. And before we go any further, I wanted to give a shout out and recognize the Patreon supporters of this Dividend Compounders with Cheese YouTube channel. As you can see on your screen right now, I make pennies from doing YouTube. So your help on Patreon is what is preventing me from having to sell a kidney on the black market to stay afloat. Thanks once again. I love you guys. Now back to the video. So to summarize the past 4 dividend ETFs that we just talked about, this is what we're working with. The next ETF is the iShares Preferred and Income Securities ETF. Ticker symbol PFF, the expense ratio, not too bad, 0.46%, and their strategy is to invest into have a portfolio full of preferred stocks, which as they quote, have characteristics of a bond that pay a fixed dividend and stocks that represent ownership of a company. And the PFF strategy is to be competitive with the high yield bonds. So we can effectively benchmark them with BND and LQD. As we scroll down to take a look at their portfolio holdings, it should be pretty similar to LQD, except instead of going all out with the financials, these guys are a little bit more diversified across the board of whose preferred shares they're buying into. And as we take a look at their total history on the stock market, publicly listed in 2007, pretty long timeline, which I like to see. But what I don't like, when they debuted, they were at $50 a share. And since then, if you look at the all-time total return for just the share price, not taking into account the dividends they paid you, you would be down by negative 36%. And what almost gave me a heart attack is during the Great Recession, they even reached a very low of $15 a share. Now, if you scooped up a ton of shares, PFF at $15, you're probably a happy camper because now you're up by 100%. But if you were one of the unfortunate souls that bought into it at $44, dude, you would not be happy because you would think with due time, your capital allocation in your portfolio would have recovered. No, if we zoom forward, you would still be down by negative 29% into the red. So, even though it behaves and acts like one of the bond ETFs, instead of preserving your capital throughout the ages, it seems like they are slowly declining year over year and consistently. So what I see, not a huge fan of. But maybe their dividend profile looks a little better for someone who's contemplating PFF for their retirement portfolio. As we jump over to take a look at the yield is 6% finally. This is really good. And what makes this even better is that the payout is every single month, which would help you with calculating the bills you need to pay or for the Viagra pills that you might need. Pretty solid. But is their history good? So honestly, I don't think this is the worst thing in the world, but what you do want to be mindful of is back in 2015, they paid you 17 cents every month, and now you're still paid 17 cents every month. I don't think this is the worst thing, but for a retirement portfolio, you do need to see some growth happening consistently and reliably year over year so that your dividend payouts are adjusted and keep up with the rate of inflation. Historically, it's at around 3%. So if you're being paid 17 cents in 2015, the valuation of 17 cents today in 2025, it's not the same worth. I mean, I live here in Japan, but I heard right now in the States, a dozen eggs is like, what, 8, 9, 10, 12 bucks. And I get it. It's because of the bird flu when we had to cull a lot of birds. But using another example, like the price of gas. Let's go ahead and assume back in 2015, filling up your car, a tank of gas is like 50 bucks. Well, in 2025, with inflation throughout the ages, now that same car, that tank of gas is probably what, 80, 84 bucks? And so if your dividend payout is staying flat and the same, it's not a good picture for retirement. But to backtrack on what I just said on why it's not the worst thing in the world to have that steady, consistent 17 cents throughout the ages is because if you do your math correctly and you realistically only need, 5% dividend yield to pay for all of your living expenses, then you can decide to reinvest that 1% back into your portfolio to buy more equities, ETFs, bonds, or even PFF. Or you can use that leftover cash to how you see fit. But for a long-term retirement horizon, buying into this at age like 66 and hoping to keep it into your account until you pass away at like 91, probably not the brightest idea. But if you're going to be buying into something that has a really high dividend yield that is growing relatively flat, I still don't think it's the worst idea in the world if you're going to be doing it for a short term to use that dividend yield for other purposes, to use that capital to deploy, to buy, to pull the trigger on some stuff on your watch list when they're at a really good price now, or for you to use it to reinvest in the context of a short-term horizon, maybe like a year or two. Would I ever want to hold something that has a high dividend payout that is relatively flat for a long-term horizon? For me, that's a pass and that's a no. Because when I am retired and I'm really old and I have wrinkles all over my nuts, I don't want to be sitting there and trying to fudge and play around with the numbers to figure out how can I increase my dividends because my bills are going to be increasing year over year. So I'd rather just buy into something that is so high quality that they're doing that work for me and they're growing the dividend payout year over year. So it covers my basis of keeping up with the cost of living and inflation. Just some stuff to think about. So when it came to their safety, I went ahead and put them as a D+ because they're consistently declining year over year. They started out at 50 bucks a share, and now PFF is $31 a share. Their history, I'm not really a fan of what I saw with how much volatility. As a matter of fact, during their worst year, back in 2022, they were down by negative 18.5%. Gosh, that is terrible. I think the only redeeming quality about PFF is their really high dividend yield of 6%. And you would think like, dude, shouldn't this be at least a B then? No, because it's flat, it's not growing. So are you going to label me as stupid or ignorant if I go ahead and place PFF right next to their bond buddies? I think all three of these are pretty much the same thing, except I think PFF is the worst out of the bunch. I would never touch, as a matter of fact, I might even bump them down right here. Let's just go ahead and do that. PFF, E tier. I would rather invest into one of these bond ETFs over PFF. I think their strategy sounds good in theory, but in actuality and how it plays out, trash. Terrible. The next ETF is Charles Schwab U.S. Dividend Equity ETF, known as SCHD. In the dividend investing community, people commonly refer to this as the golden standard, and their strategy is to follow the Dow Jones U.S. Dividend 100 Index, which I would argue pretty good criteria metrics to be a part of that list. So it's quality dividend players with strong cash flows. And the expense ratio is really low at 0.06%. And before you think I'm biased, I promise I don't own any shares of SCHD. And as we scroll down to take a look at their top 10 holdings, which this is pretty heavy weighting. Pfizer at 4%. I'm not a fan of the pharmaceutical companies, but it makes sense. Their financials are pretty sound right now, and they are undervalued, which is probably why they're adding more weight to it. And we have Coca-Cola, Cisco. These, as you can see, these are all quality blue chip companies. Am I a fan of their distribution of what is prioritized? No, but on paper, yes, they are good, solid companies. I wouldn't have any pharmaceutical companies in the top 50. If we're going to have the pharmaceuticals, put them in the 70, 80, or even 90th position, not in the top 10. As we jump over to take a look at their history, they were publicly traded and listed on 2011. So I think it's a pretty good timeline. Remember what I talked about earlier in the video during the intro. For the criteria of their history, one thing that I'm looking at is for their share price. I don't care if it goes up or down, but for it to remain relatively flat or stable, good. However, I want that dividend to be constantly going in the right direction and to have a good dividend yield, right? However, when we think about SCHD, unlike the other ETFs that we have looked at so far, instead of being relatively flat or being on the decline like PFF, instead we're seeing a pattern where they're growing in valuation almost every single year. Of course, 2020 is an outlier example, a catastrophic event, but in the grand scheme of things, this is a ETF that is growing in their share price, but also with their dividend, which we're going to take a look at here in a little bit. However, it is worth noting that in 2018, SCHD was in the red, and also in 2022. So they were down by -5% in 2018 and -3% in 2022. That's not bad at all. That's very good. So their volatility, solid. And as we jump over to take a look at their dividend profile, right now the dividend yield is 3.5%, which is a little low. However, if they are growing it in a very reliable and predictable manner, I think it kind of makes up for it. Because if you buy into it today with a 3.5% dividend yield, then eventually your yield on cost might be like 15% dividend yield as their share price keeps going up and as the dividend yield keeps going up as well in terms of the payout. So as we scroll down to take a look at the history, we want to see a trend that is at least stabilized but growing in the right direction slowly over time, or for the dividend yield to keep up with the share price appreciation. And as we take a look at SCHD, I'm telling you guys, this is really beautiful. What you are seeing is that almost every 365 days, they bump up the payout of the dividends consistently, reliably. Unlike the strategy and priority of PFF of keeping that dividend payout flat for over 10 years, SCHD has the dividend investor in mind because they're increasing that payout almost every year. So when it comes to their dividend profile, I loved what I saw. I just did not like the yield. And to back it up, let's talk about their safety. Because their volatility was so good, especially in comparison to the quote-unquote safe investment options of the bonds, I loved what I saw. Even in their worst years, we're talking about like -5%. So if you buy into SCHD, you don't have to worry about your portfolio's valuation going into the red. I know most of us that are retired or going to be retired, you're probably only going to care about the income generated or the dividend, but you also have to take care of the capital of the portfolio. You can't just let that thing just keep going into the red. And when it comes to their history, as I just alluded to, how they sailed past the storms, their dividend history and their lifespan, I think it all looks pretty solid. I put down a B+, but I think honestly, man, is it weird if I even bump it up to an A-? I think out of all the ones we have seen so far, they have the best history pound for pound. And their dividend health, I put down an A. I'm not a fan of the dividend yield being 3.5%, but I think that's very healthy and sustainable, especially for the long run. Even 10 to 20 to 30 years from now, a 3.5% dividend yield is sustainable. But your yield on cost, it might be like 15, 25%, depending on if you buy it today at 28 bucks and in the future it trades for like 80 bucks. But obviously every single time that it reaches like 50 or 60 bucks, they do a stock split. So you're probably not going to see it reach 80 bucks. You know, I went back and forth. I'm like, do I want to put it into the A tier or do I think they belong in the S tier? I think all things considered, I'm being serious right now. Based on what we have seen so far out of all the ETFs evaluated, to that loved one, I would recommend SCHD. I would have confidence in recommending SCHD for a retirement portfolio, not a dividend growth investor, but for someone that is looking for that steady income that is keeping up with the rate of inflation and is growing. I don't think you can go wrong with SCHD. So if I have that much conviction and faith in SCHD as someone who has not invested into it but knows the merit and value in it, I think it's going to be an S. I know, it took us this long to finally reach the first S tier, S being excellent, so good, delicious. And if you disagree with me, pause this video right now and let me know in the comments section on why SCHD belongs in the F or E or D or C tier. Let me know why they don't belong in the S tier in terms of the criteria of being safe, their history, and dividend health. Tell me. The next dividend ETF is the JP Morgan Equity Premium Income ETF, also known as JEPI. And their strategy to provide you a dividend income is through covered calls on the S&P 500. If you have no idea what covered calls are, I made a very good video explaining what it is, and I'll leave that video down below in the description or in the pinned comment so you can refresh your memory on what covered calls are. And their expense ratio, they charge at 0.35%, which isn't too outrageous. And when we take a look at their top holdings, well, you got all the big dogs in the S&P 500. We're talking about Amazon, Meta, MasterCard, Visa. For the most part, with the exception of AbbVie, I think this is pretty good. So I like their holdings. Their strategy, a little questionable because I'm not the biggest fan of covered calls. It makes sense until it doesn't. And when we take a look at their stock market history, they're relatively new. They've only been around for about 5.5 years, so not much history to work with. But from what we can see, this ETF tends to be pretty stable and reliable. Yes, there's peaks and valleys, but for the most part, relatively flat with a really high dividend yield. But one thing that I do want to call out, I guess this is only in the context of a dividend growth investor, for the past 1 year, only up by 3.8%. So capital appreciation, not really there, but hopefully the dividend situation is a little different. And right now, their dividend yield is 7%. I like it. That's good. That's a respectable 7%. The payout is every single month. And by the way, the dividend payments are not qualified. They are going to be taxed at your ordinary income bracket. Something to be mindful of. When we take a look at the pattern, it's kind of flat and it's inconsistent. Sometimes it goes up and sometimes it goes down, depending on how the premiums on the covered calls are doing that they're selling. So the yield is good, but the growth rate thereof, as you can see right here, sometimes it grows by 65% and sometimes it goes down by negative 29%. It really depends on the performance and the volatility of the covered calls. So their dividend profile, not exactly the healthiest, but it is good. It's juicy at 7%. And although we don't have the greatest timeline to work with, back in 2022, their volatility, they were down by negative 3.5% for the year. And so I thought I would give them an A-. You would be like, wait, SCHD went down by negative 5%. Why doesn't this quantify JEPI as A as well? Well, that's because SCHD has a lot more history and timeline for us to observe and criticize them with. But for JEPI, we're only working with 5 years. So A- for 5 years. I think that's pretty good. For the history, I think they're pretty solid. I don't think they're the safest thing out there, but it's not exactly terrible either, as long as you understand the ramifications and the strategy behind covered calls. And for their dividend profile, I went ahead and gave them a C-. I thought being relatively flat, but being inconsistent up and down throughout the years, not exactly the prettiest picture. And it's really unfortunate for me to say, SCHD set the tone and the standard really high. That's what we want to see, right? That payout to be consistently growing in the right direction. But for JEPI, I don't know. However, they do have the best dividend yield that we have seen here today. And I'm warning you, the next 5 to 6, the next 6 ETFs that we're going to be talking about, their yields phenomenal. So if you think 7% is decent and juicy, wait till you see the next ones. So when it comes to JEPI, where would I rank them? Well, I think overall their grade should be somewhere around like a B plus, A minus. And I think what is holding them back is their slightly riskier investment strategy. Rather than just having the S&P 500, they're doing covered calls, but also the inconsistency of their dividend. Sometimes it's inherently going to pay more, and sometimes it's going to pay less. So not knowing that stabilized number that you have in your head, like, okay, when I retire with my $1.5 million portfolio, I need to see a 5% dividend yield. But with JEPI, sometimes it's going to be 8%, and sometimes it might go down as low as 3%. So that volatility in the dividend is something to also take into account. So I think just thinking it through right there and talking it through, I cannot put them into the S tier. They're definitely not S tier. I think they're back and forth between A and the B. I think as of right now, I think I would put them into the A tier. And the next ETF is the Global X NASDAQ 100 Covered Call ETF. Very similar to JEPI, but instead of the S&P 500, they're doing covered calls on the NASDAQ 100, which is primarily associated with the tech giants. Anything that's not a financial company. As we take a look at their expense ratio, it's 0.61%, which isn't that bad, but it's a little higher than the ones that we have seen so far. And as we look at their top 10 holdings, they have all of the big hitters. They have Apple all the way to Costco, Tesla, Netflix. I like the portfolio holdings. I just don't like how it's covered calls. If it was a NASDAQ 100 associated dividend income ETF, I would be happy. But when you think about the NASDAQ 100, think about these big dogs. They don't exactly pay the best or the brightest dividend. So it makes sense on why they have to do covered calls to generate that income to give back to you. And as we look at their stock price history, QY debuted in 2013 at about $25 a share. And since then, I mean, it's a similar story to PFF. They've just been on a steady, consistent, reliable decline. All time, they're down by negative 27%. Their volatility, I don't like what I see. However, if you did buy into them at their lowest in the pandemic of about $18, you would be relatively flat. Actually, I take that back. You would still be in the red by negative 2.3%. But I don't know. I really don't like what I see. And to elaborate on that, in 2022, their worst year, they were down by negative 19% for the year. So we started at $21 and they finished the year at about $16 a share, 15 bucks a share. Not good. So the share price is getting crushed and is declining year over year. Hopefully their dividend is a better situation. So when I take a look at their dividend yield, it is currently 12.5%. I'm going to be completely honest with you, that is a dividend compounder with mozzarella, Parmesan cheese. That is juicy, and they pay it out every single month. But what I do want to keep in mind is, although the dividend yield is juicy, their share price is just getting crushed. So it kind of balances it out. But hopefully the picture and situation of the dividend is good. So let's take a look at that. And as you can see, it's relatively flat throughout the ages. In the past 10 years, you were getting paid 15 cents every month, and now you're getting paid 16 cents every month. I guess it did grow by a little bit, but the dividend is not growing in a predictable manner. It's just flat. But I would argue if you want a very high dividend yield that is flat, why would you ever go with PFF? I mean, you can get the same thing with QY, but also lose money in your portfolio. So you might as well just go with this one. It pays almost double that of PFF. But I mean, truthfully, would I want to invest into QY or into PFF, knowing my valuation, my portfolio is just dropping quarter after quarter, week after week? It's not my cup of tea. So for their safety, I went ahead and put them down as a D- because once again, I'm not a fan of the covered call methodology, but also their volatility is just, it's not good. So their history, I put it down as a C, because overall, I think they have the timeline for us to go back and examine them to see what they did or how they performed. But the history in itself is not really good. So a C, I think, is sufficient for QY. I mean, their dividend profile, I put a C+, because the dividend yield is really good, but it's growing relatively flat. How I would grade them in comparison to their peers in the context of a retirement portfolio. I think honestly, they would be an overall C+. I don't think they would be up here because for the average investor out there, I don't think we're comfortable with the idea of having $1 million, the portfolio valuation shrink down to 800 grand and then 600 grand in the grand scheme of like 10 years, because that seems to be the case with QY. So that's why I can't put them above average. However, their dividend yield is good. But I think I'm going to say the same thing I did with PFF. It's one of those things where for short term, for that high yield that is flat, I think it's not the worst idea. But for the long term, I think it's a bad idea. So, oh my gosh, having said that, I don't even know if I can put them here. Maybe they belong closer. No, because their dividend yield is almost 3 times that of BND. So although the situation is the same with your appreciation and the portfolio valuation shrinking, at least the dividend yield is 3x. So I guess I'll put them in C for now. Do you agree? Do you disagree? I feel like that's fair. And to summarize the 4 most recent ETFs that we just looked at, I think SCHD and JEPI, head over shoulders, way better than QY and PFF. The quality and the volatility, much better. Between these two, I think SCHD is slightly better, even though the yield for JEPI is better. The next retirement dividend ETF is also by Global X, referred to as Russell 2000 Covered Call ETF, ticker symbol RYLD. So essentially the exact same strategy as the ETF before it with QY, except instead of the NASDAQ 100, we're talking about Russell 2000, which is comprised of very small cap stocks. And when you think about small cap companies, it's the valuation of their company in the stock market. They tend to be a lot more volatile than the giants like Apple, Microsoft, Meta, the ones that have a lot more worth in their stock cap, meaning they don't go up and down as volatile as a small cap might do. And as we scroll down to take a look at their expense ratio, it's 0.63%. All right, it's not too bad. It's kind of high, but not too bad. Take a look at their top 10 holdings. This is kind of all over the place. And as we take a look at RY's history, not a pretty picture. RY debuted onto the stock market in 2019 at about $25 a share, and since then, it's down by negative 36%. I mean, watch what happened if you bought into them on February of 2020. Unfortunate soul. At $25 a share, and it dropped down by negative 38% to what was it? $15 a share. Well, if you bought into it, you might be like, dude, happy camper. I bought it at its absolute low. But since then, you would be up by 2.4%. So their stock price history, not pretty. As a matter of fact, I would say that it's volatile, but instead of rebounding and recovering, they reach a new low. This is an ETF that is declining year over year. It's pretty bad. And when we take a look at their dividend profile, the dividend yield is juicy. We will give them that. The payout is monthly, which we like. 12% dividend yield. And when we take a look at the history, oh man, this is kind of all over the place. It goes up, it goes down, but in the grand scheme of things, the payout is getting less. When they debuted, you could expect 23 cents every month, and now you're expecting 16 cents every month. And even if we just zoom back and take a look at 2022, you were expecting at least 24 cents in March, and then in the next month, 23 cents, and since then, it's just getting less and less every single month. But what is interesting about RY is their worst year was negative 13%. In comparison for QY, it was negative 19%. However, they're both declining in their share price appreciation, and it's consistent, stable. That is something that you can predict. They're going to decline. I mean, not with 100% certainty, but based on their past performance and on their timeline of what is happening. And that's why I'm not really a fan of the covered call ETFs. But if done correctly, it is okay. But for most of these people that are attempting to do covered call ETFs, not exactly pretty. And in regards to their history, not a lot of timeline to work with, so I just gave them a C. For their dividend health, it's pretty much the exact same profile as QY, so I went ahead and just gave them a C+. So when it comes to RY, the Russell 2000 Covered Calls ETF, I think what is appropriate is to place them right next to their peer and friend, QY. I don't think this is anywhere above average, but I also don't think they're as ugly as PFF. Although it is worth mentioning that if you buy into them, depending on the timeline, you might not be a happy camper. Because what history shows us is that it doesn't even matter what price you buy into actually, because it's going to decline. You could buy it right here thinking you got a good deal, but it's still in the red. You could buy it right here thinking you got a good deal, but you're still, you're in the green by 1.3%. So maybe if you buy it at the right price, it's not a bad deal, but I don't know. It's just consistently and reliably decreasing. Not a fan of this one. The next ETF is the Van Eck BDC Income ETF. Now, BDC stands for Business Development Company. It's essentially a bank that services small to middle-sized companies and lends those businesses money so they can grow, thrive, or survive. They're not actual banks, but that's the best way to describe it to someone who doesn't know what a BDC is. By the way, I'm a huge fan of BDCs because now I understand them after doing my homework and research. If you want to get up to speed, watch the videos that I made about BDCs. The ticker symbol is BIZD. Now check this out, the expense ratio. Are you ready? The gross expense ratio is 13.3%. That is absolutely diabolical. That is really crazy. The top 10 holdings, Ares Capital, ticker symbol ARC. You got Main Street Capital, Hercules, Blue Owl, Sixth Street, Morgan Stanley, Prospect. They have all the big hitters in the BDC space, but to charge a 13% fee, oh, man. Now, something that you do want to be cognizant of when it comes to BDCs is that they are very sensitive to the interest environment because they're in the business of lending money. So they borrow that money themselves and then lend it back out to the businesses. So if the interest rates are high, their margins get pretty squeezed. Anyways, BIZD debuted on the stock market February of 2013 at about $20 a share. And since then, well, let's see, they're down by negative 14.9%. If you were able to buy into BIZD at the bottom right here during the pandemic, $7.64 a share, you're probably a happy camper. But that 13% expense fee, my goodness gracious. Now, it does not take a rocket scientist to see that with BIZD, it's pretty volatile. I mean, in the grand scheme of things, it's relatively flat, actually on the decline and in red, but there is a lot of volatility. They were in the red overall in 2018, 2020, and 2022. In 2022, which was their worst year, they were down by negative 8% for the year. It's not too bad, but there are more years than not in the red compared to the other ETFs that we talked about here so far. And they have the highest expense ratio, which, man, 13%, that's pretty big. Their dividend yield is 10.5%, which is pretty standard for a BDC. I would say on average, a decent BDC pays a dividend yield of 10% if you were to just invest into ARC or Blue Owl Capital. But to have an ETF pay 10.5%, I think that's pretty good. And as we scroll down to look at their dividend history, now we're talking, what was the payout frequency? Every quarter. So every 3 months or every 90 days. And in the grand scheme of things, they actually increased it by quite a lot. They used to pay, 33 cents every 3 months, but now we're talking about 44 cents. I think the bigger question is, though, can they maintain and sustain and even grow this going forward? Because if we backtrack and take a look at 2021 and 2022, it declined, right? In 2019, it was 41 cents, but in 2020, it was 32 cents. And in 2021, it was 31 cents. So only time will tell. I think it's best to label their dividend as inconsistent, but pretty good overall. So when it comes to their safety score, I gave them a C+ because they are volatile. However, because they do have more red years than the others on this list, I cannot in good faith label them as a B. But something to note is even when they are down, their worst year was negative 8%. However, when we think about PFF or LQD, they were down by negative 18% in their worst year. And when it comes to their history, I went ahead and put a D because in the grand scheme of things, you'd be in the red with BIZD. And for their dividend profile, I thought it's slightly above average, but because it's inconsistent, I can't give them a standard B. So I think this is a fair valuation and grade for BIZD. So I think that kind of averages out to be a C overall. I think there's a lot of ETFs that are just average, especially for the retirement community. There's a lot of like average ones and then below average ones. And as you can see, there's only 2 so far that are above average. So BIZD, I think they're a C. If you're gonna go with a BDC, knowing the inherent risks involved with their sector and industry and their business scope, you might as well just go for the biggest players. I mean, watch my BDC videos to see my train of thought. I personally wouldn't go with an ETF, especially when the expense fee is 13%. You gotta be kidding me. All right, friends and family, the next ETF is the Alternative Income ETF. And in their overview and strategy, it says, we are designed to target categories that have historically offered high yield potential. So they invest into everything. It's a do-it-all hat. It's kind of like when you're at work and your boss tells you to do more with less. That kind of jerk off. But instead of the context being negative, in this situation, I guess it's a little better. They invest in all sorts of high yield assets. We're talking about REITs, MLPs, BDCs, preferred stocks. So they're chasing the yield and putting them all into one portfolio. Let's take a look at their expense ratio and then their portfolio. Their expense fee is 0.5%. Pales in comparison to BIZD. When we look at their top 10 holdings, they have some MLPs, bonds, preferred stocks, and yeah, just about almost everything. Now, Alti debuted on the stock market in 2015 at about $14 a share. Their all-time, they're down by negative 20%. During their worst year in 2022, they went down by negative 18%. And as you can see, it's not really a pretty picture. Well, I suppose if you were to buy into Alti at their absolute lows in the valleys right here at like 10.50 or even 10.30 a share, then you'd be happy. But to buy into them when they're just willy-nilly trading, I wouldn't have full confidence in that. And when we take a look at their dividend profile, it's a 7.6% dividend yield. And I think that's a pretty decent dividend yield, but based on their share price history and their behavior, I would assume that the yield would have been something like 10 or 11%. But to see a 7% and for them to be declining year over year like that, not a pretty picture. Maybe the history is a little bit better? No, the history is not better. They debuted at about 10 cents every, what's the frequency? Every month. 10 cents every single month, and now you're getting 7 cents every month. So the history shows us that the payout is getting less over time, but also the underlying asset, the share price, is also declining. So when it comes to their safety score, I put C-, but now that I think about it, almost everyone in their portfolio, the MLPs, the REITs and whatnot, they're really sensitive to the interest rate environment. The dividends itself, super volatile, and the share price is declining. I don't think C- is warranted here. I think for Alti, I think a grade letter of a D would be a little more accurate and honest. And for their history, I think it also is a D. And for their dividend health, I put a B-, but now that I see that their dividend is declining in the big picture, I don't know if B- is fair. I think that's too generous, too grateful. I think their dividend health and profile, I think something like a C- would be more appropriate. So when it comes to grading them and ranking them against their peers, I think Alti is a solid candidate for what belongs in the D tier. As a matter of fact, I think we should bump down PFF to the F. I mean, it kind of rhymes, right? PFF being in the F tier. And these two bond categories should be bumped down to the E tier. Maybe I'm being a little harsh and unfair. Let's just go ahead and bump these guys right back up to D. They can stay here. I think they're below average. I'm not saying they're the worst, but they're absolutely not a good choice either. And we'll bump them right back up to E. I don't think they're as ugly and as disgusting and evil, but obviously far from being a CHD or JEPI. And the next ETF in question is the S&P 500 Covered Call ETF by Global X, ticker symbol XYLD. So on paper, they're essentially doing the same thing as JEPI. And their expense ratio is going to be 0.6%. Not too terrible. Since it's the S&P 500 covered calls, I mean, it's going to be the exact same holdings, Apple, Nvidia, Microsoft. So I like the inherent holdings. I don't like the strategy that they apply. When we take a look at their stock market history, they debuted in, 2013 at about $40 a share. And believe it or not, they're actually in the green. 3% when you take a look at their share price all time. However, when you look at the volatility of XY, dude, this is a hot mess. They actually finished the year in the red, obviously in 2018 and in 2022. And in 2020, they also finished the year in the red. At the height of the pandemic, they dropped by, negative 31%, and they finished the year at, where is this right here? Negative 9% for 2020. Very volatile ETF, but in the grand scheme of things, I'm not saying you should do it, but if you time it and you buy them at their absolute lows in the valleys, if you have the magic to do that, I guess you would be pretty happy with the performance. But if you're one of the unfortunate souls who bought into it, 2018 at $51 a share, you wouldn't share that sentiment because you would be in the red by negative, 18%? Or even more recently, $50 back in 2021, you would still be in the red by negative 16% just for your portfolio valuation. However, maybe their dividend can make up for it. When we take a look at their dividend profile, 11.6% dividend yield, which is pretty darn good. They pay out every single month. So the dividend yield is better and juicier than JEPI. But the difference is with JEPI, instead of being relatively flat, they did have some modest gains. Whereas for XY, it's kind of flat. When we take a look at the history, I think this isn't bad at all. This is every month, right? It's going from about 13 cents every single month to what it is right now, 29 cents every month. So their dividend profile, surprisingly pretty good. All the other global X ETFs that we looked at, the covered call strategies, have been trash. But for XY, not bad. So for the safety score, I put a C+ because it's pretty volatile, and in their worst year, which was 2022, it was down by negative 12%. But for the history, I feel like it's not too bad. I think I was a little harsh when I said a D, because when I think about the stability, the consistency, and the reliability and predictability of their dividends, but also the share price and also their lifespan, I think they're more closely associated with a B-. And for the dividend health, I think it's not a B-. I think this is at least a A-. So making some modifications, because I did my own preliminary, judgment on these ETFs, but now that I'm thinking out loud, I think XY is not as bad as I first initially thought. There was a typo. Now, and there it is, XYLD. So when it comes to giving them a grade, where would I put them? Now remember, XY and JEPI have the exact same strategy. Covered calls on the S&P 500. The difference is their dividend yield for JEPI is like 7%, and for XY, it's 11%. So he wins in the category of the dividend yield if that's what you prioritize and focus on. However, the volatility, I think it's a slightly worse with XY, whereas with JEPI, it's kind of more smooth. It's slow and steady going in the right direction, positive. Whereas with XY, there's huge highs and there's huge lows throughout the year. So with that volatility taken into account, I think XY is a solid B+. Now, as a man of my word, I wanted to talk about why I didn't include any of the Yield Max ETFs. It can be the NVIDIA, Variety, Disney, or in this case, let's just look at Tesla. Why didn't I do it? Because I think they are the fundamental example and definition of a value trap. So you might be like, dude, they pay 107% dividend yield. That is bonkers. However, what you want to keep in mind is they sacrifice and kill their share price in order to pay that dividend out to you in the form of an income. So in the past 1 year, Tesla is down by negative 46%. So can you imagine your portfolio? Let's say you have $1 million, for it to drop down $460,000. However, you can boast about having a 100% dividend yield, but you're losing your portfolio valuation. And if we zoom out even further, 5 years, then you're down by negative 76%. So now you only have $240,000 in your portfolio, whereas you've been pocketing those dividends. So you're losing money in order to make money. So you're basically making nothing at all. And I would argue you're probably in the negatives in terms of the outcome. And that's why when it comes to covered calls, not all of them are created the same and have the same potential. Some of them have higher quality and better fund managers than others. If you have no idea what covered calls are, please watch the video that I made on them. But in one sentence, if I could just bring you up to speed. So Yield Max and all of these other covered call ETFs, they make their money through synthetic covered calls. Essentially, they buy in the money calls with a long expiration date that's like 5 years out, 3 years out, 7 years out. And then the fund managers sell out of the money calls with shorter expiration dates that are like 30 days, 60 days out. They pocket the difference and give that to you in the form of dividends. Do I think that's a viable strategy? I think in theory it works, but is it sustainable and is it going to keep on working? Only time will tell. It works until it doesn't. Does that make sense? So for my loved one, what is my recommendation after doing a deep dive and looking at spending the last like 30, 40 hours looking at all of these ETFs? What is my recommendation to them? Well, instead of going gung-ho and all in on just one ETF, I would advise them to diversify. I would probably throw a huge chunk, 60-70% of that net worth into SCHD and maybe into one of the bond ETFs, realizing the volatility, but with the capital preservation, especially if I can get it at a really good price. I think off the top of my head, LQD, under $100 a share, not the worst idea in the world. And then a small exposure to a covered call ETF that is good quality, such as JEPI, for that extra dividend bump. And I think that would average out to something like a 4.5 or even a 5% dividend yield that I think I would feel confident and happy about. So as you can see by doing this analysis, there's no such thing as a perfect dividend ETF, because if it rocks in one area and there's the best, they are deficient and they lack in another category. But if we think about what is the best well-rounded dividend ETF for retirement, I think it's honestly SCHD. They're growing in their share price, they're growing in their dividend payout, and they're consistent, reliable, and has good history. I think that's why they are a golden standard in the dividend investing community. And I hear you, that was a lot to take in and a lot to think about. But for me, I would not invest into any of these. And that's because I prefer individual stocks and just picking the winners within an ETF. Remember with BIZD, he's charging a 13% expense fee, whereas I would just invest into the best BDCs within their portfolio, such as ARK, Main Street Capital. Why would I pay BIZD that 13% fee? Yes, to diversify your holdings in a specific sector or industry, but if you know what you're doing, you don't have to diversify. Diversification helps you out if you don't understand the sector and the risks associated with it. If you know what you're doing, you don't have to diversify into all of the crap with the winners. For me, I just like picking and investing into the winners. I mean, I say that right now because I'm like 30-something years old, but I'm sure as I get closer up there in the retirement category and age, I'll probably invest into a few ETFs and then a dozen or so high-quality individual stocks. That's me, though. I mean, I can change my train of thought, but right now, my strategy for retirement is probably something like 80% in individual stocks with like high quality compounders such as like Realty Income Corporation, ARK, Hershey, all of these blue chip companies that have a good dividend yield, and maybe 10 to 20% into a few ETFs. Anyways, and that's all, folks. I hope you learned a thing or two. Do you disagree or agree? What is your takeaways from this video? Let me know. Because when I talk to you guys and I get no feedback or no comments, I literally feel like a schizophrenic. I'm just talking all of this out here to this world, and there's just no one saying anything back. Even if you choose not to comment, I love you guys. Stay safe. Good luck in the stock market, especially if you're contemplating retirement. And yeah, I'll talk to you next time. See ya.